Perhaps one of the biggest obstacles that prevents most people from exploring day trading is the pattern day trader rule. Hi, this is Dan with daytrading.buzz, and in this video, we will discuss the pattern day trader rule. We'll go over what it is, why we have it, a brief history on how it came about, how it affects you as a trader, methods to work within the pattern day trader rule, and methods to avoid the pattern day trader rule altogether.
So, what is the pattern day trader rule? If you have less than $25,000 in a margin brokerage account with a US based broker, you can only make up to 3 day trades within a rolling 5-day trading window. If you're outside the US with a non-US broker, the rule does not apply. It is a US rule only. So, what counts as a day trade? It is one round trip. A day trade is buying and selling or shorting and covering the same equity during the same trading day. You can buy the same stock 10 times and sell it once as a partial or a whole, and this will count as one day trade. You can also buy once and sell partials multiple times, and this only counts as one day trade. So I'm sure you're wondering, what does not count as a day trade? You could buy a security today and sell it tomorrow. This will not count towards your 3 day trades. You could buy 100 or more different stocks today and sell them all tomorrow or any day thereafter, and this will not count towards your 3 day trades. Keep in mind, this is on a rolling 5-day trading window. For example, if you make a day trade on Monday, an additional day trade on Tuesday, and one more day trade on Wednesday, after the day trade on Wednesday, you cannot make another day trade on Thursday or Friday. But come the following Monday, one day trade drops off and you will now have one day trade available. If you wait until Tuesday, you will then have 2 day trades available, and so on. So what happens if you place that 4th day trade? On the 4th trade, your account will be flagged as a pattern day trader account and you will receive a margin call. You will then be required to bring your account up to $25,000. If you cannot bring your account to $25,000, your account will be restricted for 90 days. Depending on your broker, your account might be automatically converted to a cash-only account, or you might have to request this change if you plan to trade during the 90 days. So why did this pattern day trader rule come about? During the 1990s, the internet brought on a collision of 2 major events that would forever change the face of trading. Most notably, online discount brokers. For the first time in history, it became easy and inexpensive for the average person to trade stocks. All you needed was a computer, an internet connection, and an online broker account. And boom, you're a trader. The second event, the dot-com boom. The internet was new and fresh and rapidly changing how we do almost everything in life. Countless number of new tech startup companies were popping up, all with the promise of being the next big thing. Combine a bull market, hot new IPOs, and a flood of new traders and investors with high leveraged margin accounts, and the stock market went crazy. Day trading was the hot new thing, with most tech stocks all moving in only one direction. Overconfidence took over. Like the saying goes, everyone is an expert in a bull market. Then, on March 10th, 2000, the dot-com bubble burst, causing one of the 3 biggest crashes in the history of the stock market and resulting in a loss of almost $8 trillion of wealth. By no means are retail traders the only cause for the bubble to burst. You had corporate corruption, fraud, worthless companies with billion-dollar market capitalization. Valuations for these companies were based on potential earnings and profits that were projected years out, assuming that the business actually succeeded at all. There was an overabundance of venture capital funding that would freely invest in any company with a .com after its name, and most investors completely ignored fundamentals. Shortly after, the SEC and FINRA stepped in to implement a vast blanket of reform to stabilize the market and to prevent future occurrences. Most notably for day traders, the agencies enacted Rule 2520, the pattern day trader rule. Many believe the PDT designation was put into place to limit the risk on brokerages and to ensure that any substantial trading loss could be offset by the trader's own account. In my opinion, Possessing $25,000 to trade with does not make a person any more qualified as a day trader than someone with a smaller account. Depending on your size, you could just as easily lose $25,000 just as fast as you can lose $2,500. And with the pattern day trading rule, being stuck in a trade with no available day trades while a stock's price is dropping fast with no end in sight certainly does not protect the individual trader. It is my opinion that the pattern day trader rule has little to do with protecting the individual traders and has more to do with an attempt to protect the overall market. Day traders add liquidity to the market. This is good. They also add volatility to the market, which is great for day traders, but bad for the overall market. And when you have a large number of day traders that do not know what they're really doing, the volatility is going to be greater. By eliminating the number of individual traders that can make day trades and forcing the majority of people with online brokerage accounts into investing and not trading, the market will be far more stable with people sitting through the ups and downs than everyone panicking or trying to take advantage of these moves. So, do you have any options if you're trading with less than $25,000? The answer is yes. There are options to work within the pattern day trader rule, or there are additional options to avoid the PDT rule altogether. Each option has their pros and cons. The first option, you can trade with a cash account. With this type of account, you can trade unlimited until you run out of buying power. Great, problem solved. Well, not exactly. You'll have to work with T+3, meaning you have to wait 3 additional days for your funds to settle before you can trade with them again. The advantage with a margin account, you have funds available either immediately after closing a position or they're available the next day. Option 2, you can open up multiple brokerage accounts. Your day trades only pertain to each individual account. Say you have $12,000 to trade with. You could split this $12,000 into 2 separate accounts with $6,000 in each account, and then you would have 6 day trades available. Or you could take this money and split it into 3 accounts, $4,000 each. Then you would have 9 day trades available. The downside to this is you have less funds within each account to trade with. So your position sizes could be smaller depending on how you trade. Option 3, you could trade with options. While they still fall under the pattern day trader rule, you now have T+1. So your funds settle the following day. While this may seem like a good alternative, I would not recommend trading options to a new trader, since learning to trade equities is tricky enough all on its own. If you attempt to throw on learning options on top of this, your chances for success greatly diminish. Option number 4 would be to trade with a prop firm. Many of these are similar to opening a brokerage account, but with them they allow you to either trade with the firm's money or you pool money with other traders, which then allows you to avoid the pattern day trader rule, but you will be paying this company a certain percentage of your profits, and I'm sure there are other fees involved. For some of these prop firms, you are required to have either a Series 56, 55, or Series 7 security license to trade. I personally have no experience trading with a prop firm, but I am aware that there are many scams within some of these prop firm companies where they attempt to milk every cent out of a new trader, taking advantage of their ignorance. One thing to look for if you plan to join a prop firm is check to see if they are attempting to charge you thousands of dollars to buy their trading program in order to learn how to trade prior to actually being able to trade with them. This is one of the biggest scams known with these prop firms. If you plan to trade with a prop firm, I would urge that you place a significant amount of time in researching the company prior to actually joining. The last option, you could trade with an offshore broker. This option allows you to avoid the pattern day trader rule completely. There may be others, but there really is only one decent broker that I'm aware of, and that is SureTrader. While I believe it is a great option to avoid the pattern day trader rule, I would not suggest that anyone open up an account with them until you had fully explored the pros and cons of using an offshore broker beyond the limited information that this video will provide you. The positive aspects, it is a good platform for trading volatile stocks. It was started from the same people that developed SpeedTrader, which I consider to be a good U.S. broker. They have fast executions, and they actually have a fantastic inventory of shorts to borrow. Obviously, the main advantage, there is no pattern day trader rule, and you can trade unlimited. Your funds are available to trade with immediately after you close a trade. They do provide a 6 times margin. While I do not normally recommend trading on a margin, the advantage here is you do not need to place a large portion of your funds in the account to day trade. Suppose you had $12,000 to trade with, but you're not comfortable sending $12,000 to an offshore broker. You could send $2,000 and then have $12,000 in buying power with the margin. Just realize trading with a high margin can be dangerous since you can lose more than you actually have within your trading account. You have to be careful. If you do trade with margin, I personally would never risk more than I could comfortably cover if I were to take a loss with a losing trade. The negative aspects, they're not the best broker, but they're certainly not the worst broker either. Their customer service is not the best, but it's definitely better than what it was when they first started. They're located in the Bahamas. While I believe the laws may be fairly stable to provide some level of protection, it's outside the U.S., and I highly recommend that you look into this further before funding an account and understand your risk. I have used them, and I still have a small account with them. If you're sending money outside of the U.S., you must report your assets to the IRS once it's over a certain amount. You must also report your profits and loss, just like you would for a U.S. broker. This is in no way an endorsement for any of these options. The purpose of this video was to educate traders on the potential options. Obviously, the best method to avoid the PDT limitations is to have over $25,000 in your account. If you have any further questions, please feel free to send me an email or provide a comment, and I would be happy to respond.
If you found this video on the pattern day trader rule helpful and you would like us to continue to make more videos, we ask that you please subscribe to our YouTube channel and make sure to like this video.